Welcome to the PJ Finance Show. Today we will discuss a framework for country investment, Part 2.
Hey Joe, I'm surprised you're still here.
What do you mean?
I thought you got fired because you left during the office hour last time.
Well, I could say the same about you. So, why are you here?
Your last explanation helps me a lot, so I was wondering if you can help me understand more about real GDP.
Only if you pay for my lunch later.
It's a deal.
And a large Hong Kong milk tea boba.
Sure.
And a large slice of New York cheesecake.
Don't push it.
Two important concepts. Firstly, real GDP is nominal GDP minus inflation. Second, when the GDP number is announced, it is presented in the form of quarter-on-quarter annualized percentage change.
Yes, I am aware of this. Real GDP tells us how fast the economy is really growing. The way I think about this is if you get a 3% pay raise when inflation is 3%, you are basically getting nothing.
True. Sad face emoji. If I get a 3% pay increase when inflation is 4%, I am getting a pay cut. A real pay cut.
Is it true that a recession occurs when we have 2 consecutive quarters of negative GDP growth?
That is a common misconception. The National Bureau of Economic Research, NBER, defines it as a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales.
It is good that they also set the dates for the start and end of every recession, which make it easier for us to study what had happened to the markets during recessionary periods. Why does it usually indicate in the newspapers that the real GDP is higher or lower than expectation? What was the source of the expectation?
The expectation is the average of leading economists' forecasts collected by companies such as Bloomberg and the Wall Street Journal.
Oh, this makes sense. When the data released, say GDP or non-farm payroll data, is announced greater than expected, the yield in the bond market will be higher.
Yes, in aggregate, when U.S. economic surprises are higher, the bond yield will go up. It is because when an economy turns out to be stronger than expected, analysts and investors would expect more inflation, thus the interest rate will increase as well. And similarly, when the economic surprise index is stronger, the stock market trades up.
So, how long after a recession does real GDP return to its previous peak level?
It depends on what causes the recession and what kind of policies are implemented. For example, during the 2007 to 2009 global financial crisis, the Federal Reserve introduced quantitative easing, which allowed many underperforming companies to avoid bankruptcy.
While that would avoid a greater loss of jobs, these unperforming companies continue to hang around as zombie companies.
In general, the primary cause of recessions is overinvestment. Too much investment in housing in 2008, IT in 2001, and commercial real estate in 1990.
Too much investment can be a bad thing because in aggregate it leads to overcapacity, price cuts, and the profitability turns into losses. Hey Joe, you mentioned that GDP data are announced on a quarter-on-quarter annualized percentage change.
When the GDP number is announced, it is presented in the form of quarter-on-quarter annualized percentage change.
This does not sound right. When we compare Q2 to Q1, we can see that there is a seasonal effect. We spend less during Q1, which is the bulk of winter, and more during Q2, which is the beginning of summer. Comparing more spending over 3 months to a quarter of less spending, then annualizing it, which to simplify means multiplied by 4, greatly magnifies the strength or weakness in the growth rate. The seasonal effect is exaggerated.
Yes, however, there's a better way to assess the trend of real GDP. We can analyze it by looking at the quarterly annualized rate over a 12-month period. This way we eliminate the seasonal effect and compare Q2 to Q2 of the previous year.
It sure is easier and more accurate to figure out the average growth on a year-on-year basis. This makes sense. You earned yourself a small slice of cheesecake. In conclusion, We should just use the 12-month period quarterly, annualized percent rate.
Not really. It all depends on what you are analyzing. If you are looking at the trend of the economy, you should use the year-on-year basis. When analyzing the performance of a firm, say Apple or Google, which reports quarter-to-quarter earnings and revenue figures, you would want to compare against the quarter-to-quarter GDP growth rate.
Ah, I see what you mean. Once again, thank you, Joe. I owe you my life.
That seems to be exaggerated. Now, let's grab the lunch you promised to get. I'll order the most expensive thing on the menu, plus the boba and cheesecake.
Thank you for watching.
This presentation on a framework for country investment is brought to you by the PJ Finance Show.